Hey everybody, welcome back. This week I have on CJ from Strategy. CJ, how's it going?
All good. Thank you for having me on, Joe. I believe it's my third time. So, really love speaking with you. Excited for this chat.
Yeah, absolutely. I enjoy our conversations and it's always fun to talk about Bitcoin, of course. And now is a very interesting time, right? Because yesterday or early this morning, I think Bitcoin wicked down to 60,000 as we're recording this around market close on Friday, February 6th. Bitcoin's around 70,000, so it's a little volatile. What do you make of this extreme volatility that we've seen?
I think we're just back to the good old days of high volatility, Bitcoin price going down a lot, going up a lot. And I feel it's just business as usual. A lot of new investors in Bitcoin would obviously, be a bit worried, be a bit skeptical of what the future holds. Which would be very similar to how a lot of us would have felt initially when we bought into Bitcoin. The first time you go through a bear market, the first time you see the price fall 10% in a day or like 30% in a month or a matter of months. So it's definitely, challenging for new investors, but for the people who've been in the game for a long time and who have, 100% of their assets allocated to Bitcoin or Bitcoin derivatives, I think are just ready for the volatility. I would say though, I wasn't expecting the price to fall all the way to 70, 60K, 6 months ago or 4 months ago when we were closer to 100K or when we were at the all time high. I think the all time high was much more muted than what a lot of us would have guessed, less than 2x from the previous all time high. So it wasn't anything like the retail mania that we saw in 2021, nowhere close to a blow off top like a lot of us would have predicted, which then made me think that the drawdown would be less severe. And I think I was kind of wrong there as well. So it just shows you that you should not get too emotional with short term price predictions and, just have your long term vision. Don't get over levered. Don't get over allocated if you don't understand it deeply. And you just got to go with a 5 year, 10 year time frame and, it's going to outperform everything else.
Yeah, you make some great points. It's like if you're a relatively normal person that holds a lot of cash in your bank account, like the S&P has extreme volatility to you. And then if you're, an index investor, then Bitcoin has absurd volatility, to you. So it's kind of just funny to put into perspective. But yeah, it's like if you actually expect Bitcoin to have a 30 to 50% CAGR over a long amount of time, then volatility is probably almost guaranteed to be a part of the price action.
Yeah. And, it's like Michael likes to say, volatility is a gift to the faithful. If it wasn't volatile and if it was just going up in a straight line and everyone understood it at the same time, it wouldn't have the same sort of reward proposition for you as an investor who's put in the time and who's understood it deeply. So you should just take this as an opportunity to stack some cheap sats if you have any cash remaining, and hopefully you aren't over levered and you have steady income. You do save on a month by month basis, so you can continue to stack sats. And I think, maybe it'll take 6 months, maybe it'll take 12 months, maybe it'll take 18 months, but we will recover. We will form new all time highs again. And I think you should just stay away from making short term price predictions and just play for the long term. Like you said, 30 to 50% over the long term is perhaps a reasonable base case.
Yeah, I agree. You brought up 2021, that cycle. I think that, like that was from the bottom, I guess, of 2020, up from 3,000 to 70-ish thousand. Like that was, pretty good bull run. But I still think even back then, everyone kind of expected like a blow off top, maybe to like 100K. So it's like two cycles, quote unquote, cycles in a row that, Bitcoin has kind of like underperformed to the upside, so to say. What do you think about Bitcoin cycles from here? Like the 4 year cycle itself has been kind of a meme, and you could argue whether it's still happening or not happening, or if it's just happening by coincidence. How do you think about cycles in Bitcoin at this point?
Yeah, it's to your first point actually on the blow off top in 2021 being, less than what you would have imagined. It's funny because I was one of the retail degen traders that got in during that last mania. Like that's when I discovered crypto first and then Bitcoin. And I didn't know that the sentiment was that could have been much higher. There were
Hmm.
obviously the shorter term implications of the China Bitcoin
Yeah.
mining ban, and that kind of had drawdown in the middle of that bull run. But it just kind of shows you that there are so many external factors that can be a big catalyst on the upside or downside, that kind of gets tough to map out this pattern and try to point it towards a particular model or cycle. There definitely was and is a strong belief that those 4-year cycles are meaningful and are intact. I personally don't think they are that useful uh, predictor. I think you can make a couple of points there. One is that the Bitcoin mining halvings were more sort of impactful in the early few years, when the impact of the halving was more meaningful when measured as a percentage of the daily trading volume or the daily liquidity. So generally, the influence that miners had in terms of accumulating Bitcoin or selling Bitcoin was a lot more impactful on the price of Bitcoin. And I think over time that gets less and less meaningful. Maybe there was some sort of reinforcing psychology over there, that people thought there will be a bull run, and people would build leverage accordingly. And then you would see eventually some negative sentiment in the market, which would lead to that leverage unwinding. And then there's a deep drawdown that happens. And it was just happening with that 4-year time frame. So that kind of reinforced the belief of the 4-year cycle. And going forward, I don't know. I think Jeff Park talks about how the 2-year cycle is the new 4-year cycle. I kind of like that this idea generally, but I just think it's going to be more dependent on macro liquidity conditions and central banks adding liquidity. Uh, Bitcoin also is very correlated sometimes in the short term to what's happening with high risk equity stocks or crypto, because there's a lot of cross collateralization that happens in people that take a lot of leverage. So if crypto has a sudden downturn, that is what happened in October, right? And there's this big theory of there were some big players that went bust in the crypto world in October last year, and Bitcoin was kind of underperforming since then relative to other commodities and equities. So there's also that factor. So I just think generally going forward, perhaps I'm not a big believer in the 4-year cycle. Um, and we'll maybe see shallower downturns. Um, but yeah, who knows? Maybe I'm completely off base.
Yeah, it's I guess one thing that you'd probably agree with, like short term is just so difficult to predict to begin with. So yeah, maybe it's a 2-year cycle going forward. Who knows? But that's a great point. Um, Related to this, topic of extreme volatility and strategy obviously talks about this and Strive as well, like having that longer time horizon. In your like personal view, like is the volatility the only reason for having a long time horizon with Bitcoin, or is there another reason as well?
That's an interesting question. I think the volatility means that you definitely cannot have a short term horizon. And if you do, then you will just think that this is a terrible decision you made, and you will blame the person who ever sort of introduced you to Bitcoin, and it just doesn't work. But I think the reason to have a longer time preference is more than just dealing with the volatility. It's almost like the that spiritual awakening that you have, or the philosophical awakening that you have once you learn about Bitcoin, and you learn about it from the Austrian economics or monetary history perspective, on just lowering your time preference. And that starts applying to everything else in your life as well. Even things that are not volatile in life, apart from money and investments, you should still have a low time preference. You should have a low time preference with your career, with your family, with where you stay, with the friends you make. And those might be very gradual things that don't really go up or down a lot. But if you don't have a nice 10, 20, 30-year long vision, then you will just make short term decisions that will be a bit rash, will be a bit foolish, which won't have long-term compounding benefits. So yeah, maybe it's just long-term compounding is important for investing and for life. And Bitcoin kind of fits into the investing category, and you need to have a long-term low time preference and a long-term horizon.
Yeah, it makes sense. This is kind of an interesting, maybe like controversial or somewhat controversial question, but like you see people talking about this, I guess, on X and whatnot. It's like, okay, last week, strategy or X treasury company bought, $1 billion worth of Bitcoin. and the price, did nothing. I'm curious, like, do you have an opinion on how would you respond to that? Like, if someone's like, how did someone buy $1 billion worth of Bitcoin or more and not move the Bitcoin price or appear to not move the Bitcoin price?
Yeah, that's one of the most common sort of comments on Twitter these days that, oh, strategy should just smash buy OTC and send the price high, or do this or do that. And some people think we're doing this and then they want us to do the other thing. And then some people think that we're doing the other thing and they want us to do something else. And it's a lot of interesting chatter and noise. What I would say is like Bitcoin trades about 80 billion to $120 billion a day in spot volume. And if strategy is out there buying, let's say, $1 billion a week, um, something between 150 to $200 million a day, it's a very, very small fraction of the daily volume. And obviously, the daily volume would have a lot of sort of the net settlement might be lower. So you can argue that it's not the right denominator. It's not the total traded volume, but it's like what's settled on a daily basis. But I still think it's a very small fraction.
Hmm.
And it definitely would move the price on the margin if someone like Strategy is buying a lot, or if another whale, another OG, another company is buying a lot or selling a lot. It definitely does influence the price on the margin. But I don't think the day to day or week to week impact is easy to decipher, because the price moves obviously depending on what's happening in the spot market, but it also moves a lot depending on what's happening in the derivatives market and what the market makers are being forced to do because of people taking positions in the derivative market. And it's just so difficult to decipher who's doing what, and make thoughtful arguments on who's moving the market. I do think on a longer term scale, these things can be a bit more meaningful. If you do see like ETFs are increasing their holdings over time, Bitcoin treasury companies are increasing their holdings over time, then you can pinpoint to them creating like this constant perpetual bid and bringing a new sort of type of demand, because it's someone who's okay taking exposure through an ETF. It's someone who's okay taking exposure through equity or fixed income. And that is just a new kind of demand. And as long as you are seeing a secular growth over there, then it's a positive catalyst. So yeah, that's just my general view that you're probably never going to see one company or one actor move the market a lot. Maybe, what could hypothetically happen is a big country comes out and makes a large announcement of buying a lot of Bitcoin, and maybe that announcement is a huge catalyst, or maybe their actual constant buying on a day-to-day, week-to-week basis, that could be a very meaningful movement on the price, which you could pinpoint. But otherwise, I think it's hard to you know point towards a company now meaningfully moving the price, including strategy.
Yeah, it's such an interesting question, and like I agree that like the Bitcoin market on a daily basis is absolutely massive in terms of volume. But like a thought that I've had, I'm curious like how much you agree or disagree with this is like, okay, if you sell $1 billion of Bitcoin on Kraken and then buy $1 billion of Bitcoin on Coinbase, obviously that should be like net neutral, like no major change. Whereas, if you think of like a treasury company, it's like, okay, you tell the bank, like, hey, let's sell $1 billion of whatever, treasury company stock. And the market kind of treats it as it's obviously not Bitcoin, but it's a Bitcoin substitute. It's very highly correlated to Bitcoin. And then you buy $1 billion of Bitcoin on Coinbase or, via, your TWAP, whatever else. Is that, is that like the same as, I don't know, pension fund that has capital allocated to bonds saying, hey, let's sell $1 billion worth of bonds and buy $1 billion worth of Bitcoin? Do you, how do you think about that?
It's an interesting thought. I think so. Are you saying that if hypothetically a treasury company sells stock, raises capital, and buys Bitcoin, that should be a bigger catalyst?
I,
Because
I'm suggesting more so it's perhaps like a more neutral catalyst, like just like if you sold $1 billion of Bitcoin on Kraken and bought $1 billion Bitcoin on Coinbase, you sell $1 billion of a Bitcoin substitute and then buy $1 billion on Coinbase. It's like, is that maybe that's more neutral than people expect, and maybe that's part of the reason that price doesn't necessarily go up. I agree that it's also there's so many other factors, so it's impossible to really know. Perhaps maybe like what's moving the price, But I don't know. It's just a thought that I've had.
Yeah, it's an interesting thought. I think I partially disagree to the
Okay.
extent that maybe new capital that's
Yeah.
coming into buying the Bitcoin backed equities like
Yep.
MSTR would perhaps otherwise be chasing Bitcoin directly. And now that they're chasing the equity and then the company is going and buying Bitcoin, it's the same net effect on the price of Bitcoin. The the influx of new capital has to happen for the price to go up, or for there to be like the marginal seller selling to the marginal buyer. And the question is, would that capital either directly go to Bitcoin and buy Bitcoin, or go via a treasury company, or via equities or via bonds or something and buy it? So yeah, I tend to think that the treasury companies are just kind of maybe opening up access to a new kind of capital that otherwise
Hmm.
wants like different risk reward or downside protection. But eventually that capital would have either just found Bitcoin directly or is now finding it through the treasury company. So yeah, I still get what you're saying with the selling on a daily basis of stock being compared to selling Bitcoin on a different exchange. Yeah, but I just think I partially disagree there though.
Yeah, I definitely agree that it's not a perfect one for one. Like, of course, there's people that are going to be buying the stock, any of these Bitcoin treasury stocks, and they can't buy a commodity for whatever reason, their investment mandate, and so on and so forth. But I don't know. It's just it's an interesting way to think about it, because it's like, okay, if a pension fund was deploying $1 billion into Bitcoin week after week after week, and the capital was coming like you know from some other asset more clearly, and then maybe I don't know if that would be more impactful or not. It's just something that it makes me almost, the thought of it, if it's somewhat true, makes me more bullish, because it's like, okay, we're buying, maybe there's actually not that much capital flowing into Bitcoin, and like once billions of dollars actually do flow into Bitcoin, maybe it's going to be a big deal. But maybe it's just a completely wrong thesis. I don't it's just something to think about.
Yeah, probably Bitcoin is just sucking the investment capital out of other assets, and the treasury companies are facilitating that migration from other equities and bonds or fixed income assets into Bitcoin. And then there will be other players that do interesting things and migrate real estate capital or other, maybe, I guess pension capital is eventually fixed income or equity capital. But yeah, it's just going to suck all the investment capital. And I think it is already sucking the investment capital through the treasury companies as well.
Hmm.
Um, so yeah, it's anyways all bullish, but it's an
Yeah.
interesting way to frame the thought for sure.
Yeah. I obviously want to ask you about digital credit. It's, I guess we're maybe a year in at this point. From, I guess, STRK was the first digital credit instrument, I believe. You can correct me if I'm wrong, but um, what do you think about digital credit at the moment? And kind of like, where do you see it going from here?
Yeah, I think it's been exactly 1 year since Strike and maybe a week more. And it's been an incredible sort of year to witness from strategy. I'm very fortunate to see how the thinking has evolved. With Strike, the original thought process was there are some defects with the convertible bonds. They only trade OTC between institutional investors. Retail can't access it. The conversion premium is low. The maturity is short. How can we really improve that? And then we landed with Strike in the preferred equity listed on NASDAQ registered security model. And then 6 months later, after iterating through Strife and Stride, we eventually found Stretch as an idea and we actually executed it because we kind of discovered what do people truly want in terms of fixed income exposure. They want something that has very little volatility and monthly fixed income, and a unique tax advantage was almost like a coincidence. It wasn't something we were necessarily solving for, the ROC dividend. But the reason I say this is because it wasn't as if on day one of launching Strike, we knew that we would find something like Stretch eventually. And eventually, when we did find Stretch, I think it's clearly become the flagship product, which we believe is the most suitable for both retail investors and institutional investors. The reason people usually chase duration or take on maturity 5 years, 7 years, 10 years out is because they're chasing higher yields and they can't get it in the shorter duration assets. But once you create something that's shorter duration with low volatility and offer like an 11% yield, like Stretch does right now, then becomes very compelling to all kinds of investors, not just the short duration ones, but also the long duration ones. So I think that's super exciting. And Stretch is just 6 months old and it started seasoning for sure. Bitcoin has been volatile in this phase. So, it's seen some drawdowns from that $100 par value. But I think it's going to continue to mature. The volatility is going to continue to come down from 10% to 5%, maybe even lower. And you'll see more and more people trust the company as we continue to pay dividends. You're obviously seeing more innovation in the market with Strive launching SATA, with other innovators trying to take Stretch, take SATA, create more products on top of it, which could be the crypto tokens, or it could be packaging it into some regulated traditional finance sort of product. It could be maybe ETF issuers and bank, like big banks actually offering regulated bank accounts backed by some sort of combination of digital credit and treasuries. So I think it's just super exciting. It's early days. It's definitely going to be the preferred choice of leverage and amplification for treasury companies because it matches that indefinite Bitcoin horizon. And I think we're going to see a lot of innovation be built on top of these products, which will be maybe, what we'll see in 2026. We'll see a lot of new, especially crypto players, take and Stretch and SATA and do really unique, innovative things.
I agree. We're seeing a number of pretty interesting products being proposed and starting to be built. What do you think is like of all maybe all of you mentioned and maybe something else? Like, what do you think is the biggest catalyst for digital credit? Is it simply like survive, pay the dividends, and prove yourself that hey, Bitcoin can be incredibly volatile, but this is actually a very serious instrument?
I think so. I think the biggest thing is just time in the market. And as each month or each quarter goes by and the company like Strategy or Strive continues to make whole the dividend obligations through Bitcoin bear markets, especially, and gain more and more trust with investors, I think that will, in all honesty, be the biggest sort of slow uh, adoption of these instruments. I think a very sudden short term catalyst is harder to imagine. Perhaps it could be something like rating agencies building new frameworks around valuing or assessing the risk of these products or assessing the risk of these treasury companies. And that would perhaps need first the treatment of Bitcoin on balance sheets to change and the way the risk of Bitcoin on the balance sheet is assessed. Because right now, by the Basel sort of norms, is just zero risk weighted assets. So those things need to change, and maybe that could be a short term catalyst. Um, and maybe another catalyst could actually be these crypto players. There is a lot of capital in across crypto tokens, across different stable coins in the crypto world, across a lot of different DeFi lending, borrowing strategies, where existing crypto and Bitcoin both don't end up being great collateral to borrow against because they're volatile. And some of these digital credit instruments like Stretch that have lower volatility can become the preferred choice of collateral to post on these DeFi exchanges for the people who want to trade or borrow against their assets and want to do it in the crypto world as opposed to the TradFi world. And maybe that really picks up steam. And maybe that could be like a big bid on these digital credit instruments relative to institutional investors and retail investors doing it through traditional brokerages. So I think that would be something interesting to observe. But yeah, probably just, you know, continuing to fulfill dividends every quarter is going to be the most important thing in the long term.
Yeah, the dollar like tokens that are, being built on top of digital credit are so kind of, I guess, fascinating because it's like, I think of the last 17 years. Okay, Bitcoin's obviously one of the, coolest, most powerful technologies that humans have discovered. And, obviously I would argue it's been very successful and, became a $2 trillion market. And then you also look at stable coins. Like stable coins honestly like have become pretty successful as well. It's a multi-$100 billion market. And arguably they're not even that great of a product. Like it pays 0% yield. It's a dollar, which like there are obviously pros to holding dollars, but if it holds 0%, like if it pays 0%, that's not a great dollar. So if you can like combine the benefits of a stable coin like thing with actual like return, I mean, it seems like this could be something that like absolutely explodes the entire market.
Yeah, you're exactly right. And you're seeing that right now with the tussle between banks and,
Yep.
Coinbase with respect to the Clarity Act and what already happened with the Genius Act. Stablecoins can't pass through yield. And the killer product that I guess banks want to release over time would be tokenized deposits, because that is something that does stay stable and does give yield. And that's what everyone wants. They want,
Mhm.
to not have short term price risk, but they want to have appreciation. They want to get some income and some yield and not just be sitting on a wasted asset. So you're exactly right. I think it's going to be something that is superior to stablecoin, something that is superior to tokenized deposits because it's giving you a higher yield. There's some volatility, but with time, the volatility will come down and people will learn how to manage their way around it. And you will see innovators come in, build products on top of it that are stripping the wall even further down to zero and creating something like what you would call digital money, the way Michael Saylor describes it. Bitcoin is digital capital. That's layer one. Digital credit is like layer two built on top of it. You need a Bitcoin treasury company to do it. You need a lot of digital equity in the first place to be able to create the digital credit. And then the layer sort of three on top is digital money, where another innovator, another third party is coming and taking digital credit, not from just one company, but multiple companies, and then creating this perfectly stable or near zero wall asset with, decently high yield.
Mhm. You had a tweet that you posted a while back, or not too while back, but somewhat recently, and I agree with it. You said, in theory, a digital treasury model is infinitely scalable as long as any capital chases USD yield, STRC, or digital credit can fulfill that demand. Can you kind of elaborate on your theory there?
I've done a couple of these in theory tweets and it triggers a lot of people. Um, but yeah, what I meant by that is the reason the Bitcoin treasury model works in its current form today is because the company can create value by borrowing capital from investors that want a dollar yield and invest it into Bitcoin. That's just going to outperform what the dollar yield demanded by the sort of lender is. And so long as there is a group of people or a decently large pool of capital that is craving the dollar yield, and Bitcoin is continuing to stay, the sound money is the best way to preserve long term capital, will appreciate over time, over and above that yield being demanded by the investor, then these treasury companies like Strategy can continue to just do this and create value. And we don't need to take any other form of risk where we take something on our asset side, we either lend out the Bitcoin or we are following some derivative strategy or we're doing something else. We don't need to do anything. The simple way for the equity to outperform Bitcoin is you just borrow at a rate lower than what the expected appreciation in Bitcoin is. And you just keep doing this over and over again. And you just keep scaling up the balance sheet. And there is no reason why you would argue that this works at $1 billion but doesn't work at 50 billion. Or this works at 50 billion but doesn't work at 500 billion. Like in theory, Strategy could be 10x the size 5 years from now, $500 billion, and doing the exact same thing. And it's just, borrowing money through Stretch effectively to invest in Bitcoin. And Stretch investors are getting 10%, 11%, or whatever the Stretch rate might be, then could be higher, could be lower, and is investing in Bitcoin. That's still appreciating 40, 30, 20%. And the MSTR investors, the common equity investors, are happy because as a virtue of being able to capture the spread between Bitcoin and Stretch, they are getting to outperform Bitcoin. And that's it. That's all you need to do. And you just keep scaling up.
Yeah. So say we get to that future where 5 years from now, Strategy is a $500 billion company. Like, what comes after that? What are the implications of this strategy continuing to work? Say it does. Like, how does this play out over like even a longer time horizon?
Yeah, it's impossible to predict what happens. And people have conceptualized many different things a large company with a lot of capital can do. And you've already seen that through history. What do large private companies or proprietorships that have a lot of gold do. They typically become large lenders of capital. And maybe that's not 5 years out, but that's more of a 50 or 30-year out thing where, Bitcoin is no longer a trillion, $2 trillion asset. It's like a 100 trillion, $500 trillion asset. Everything is kind of getting denominated in Bitcoin as the chosen store of value. People demand their wages in Bitcoin. People demand contracts in Bitcoin. Everything is in Bitcoin. And then the large players sitting on a lot of Bitcoin could be theoretically be large lenders of Bitcoin. But that's the 50-year view. The 5-year view, I think, is pretty much the same as today. It's just going to be the same thing. Strategy will be $500 billion, maybe stretches $100 billion. And we're just doing the same thing. We're just raising more and more capital through more issuance of Stretch and MSTR and buying more and more Bitcoin. What would change perhaps is that the power of the brand of strategy would be more, the power of the Bitcoin brand would be more, the attention being given to these strategies would be a lot more. There would be a lot more copycats. And, eventually it shifts from being the early adopters and early majority to like actually passing that inflection point where more than 50%, 70% of the world understands it, gets it, wants exposure to it. And, maybe we get something like, I don't know, super cycle. But that's more Bitcoin, leaving aside what happens with the treasury companies. Like you would theorize that it has to happen at some stage where there is like this inflection point.
Yeah, that makes a lot of sense to me. 5 years from now, or thinking about digital credit, like how do you see yields on digital credit evolving? It seems like so far, just looking at STRC, for example, slowly kind of ticking up over time. Do you see them, remaining flat, increasing higher, or trending down over time? How do you think about that?
I think Michael also addressed this yesterday in our earnings call in a very thoughtful manner, and I agree with that. And what he, or the way I would phrase it, is that the rate would be a function of the amplification ratio on the balance sheet in terms of what is the total size of the digital credit that you have outstanding as a percentage of the Bitcoin value. And you don't want to suddenly scale that up massively, and you want to be more methodical in raising it. So right now we have low amplification. We can sort of, in theory, have more and more stretch issuance and increase that ratio. And in order to do that, we can keep the rate high to draw in more capital and to suck more capital in, and keep it high, keep it at an elevated rate so that it stays as a very attractive instrument that is drawing in a lot of capital. But if that demand starts becoming explosive, and if there's suddenly 10, 50, $100 billion of demand that wants to come into Stretch, you don't want to do that. And you don't want the equity buffer to become very small and the amplification percentage to become very, very high, because then you increase the risk on the equity tranche, the common equity. It becomes super, super volatile, and you don't want to take it to obscene levels. And that is when you would start considering maybe lowering the rate. But it's kind of a matter of what happens in 2 years, 5 years. It's very hard to predict how much, exact demand does Stretch get and how much capital flows into it. But yeah, once the ratio starts becoming very high is when you could start thinking about lowering the rates. And obviously not lowering the rates to hurt the price. You would want the price to stay at the target price range between 99 to 100 or 99 to 101. And it would just be a function of those two things, keeping the
Right.
price stable near 100 and managing the overall sort of leverage or amplification ratios.
That makes sense. This is a different topic, but I was thought about it the other day. Do you think there could ever be a gold treasury company?
Well, in theory, they could. And it would not be a great company because I think people have tried to do it with silver, right? And corner the silver market. And there are so many large gold miners that mine a lot of gold, but they don't do it. They do sell the gold all the time. And the reason is because the way most Austrian economics describe it, or especially Seyfedin describes it, is that you just end up increasing the price if you start applying that constant buying pressure. And when the price is much higher than the marginal cost of production, then you just invite a lot more players to come in, increase the supply of that commodity, and all of that new capital starts chasing the mining value proposition. the supply goes up a lot and it gets dumped on the market, and then the price crashes. And that will happen now with gold and silver, regardless of someone trying the treasury model, because the price has gone up a lot. I imagine it is far higher than the marginal cost of production. People will come and dump their gold and silver into the market because they're just mining more of it from the ground. And maybe you will see the two commodities not have another meaningful rise for, I don't know, maybe a year, maybe 5 years, maybe 10 years. Obviously, it then depends on macro liquidity conditions and everything as well, and the debasement trade. But that's the issue with all other commodities, that they don't have perfect scarcity and they don't end up being the best tools for preserving capital over the long term. And that's the unique thing about Bitcoin, that no matter how much capital chases mining more Bitcoin, the issuance and the supply stays fixed in time because of the difficulty adjustment. So it's perfectly inelastic supply that you know exactly how it's going to play out over the long term. And I think it only works with Bitcoin. But I'm curious, do you think there is a possible way of making it work with gold?
Yeah, it's a good question. I mean, obviously, I certainly think it works best. Like it works with Bitcoin. Like, if you expect Bitcoin to have a 30% CAGR, then it would be reasonable for someone that expects that to want to buy the common equity because your cost of capital might be 10%, 15%. Like doesn't matter as long as you expect Bitcoin's CAGR to be higher than 30. And then obviously digital credit, and a Bitcoin equity, treasury company massively over collateralized. So and if Bitcoin keeps going up, that's a great deal as well. But like with a gold treasury company, I think you could make the argument that like a digital credit product or a gold credit product actually could still be possibly interesting because like okay, say you have a gold rating instead of a BTC rating of 5x, and gold's pretty unvolatile. So you might, and say, the gold credit product, pays a 10% yield. Uh, you might have like 50 years worth of gold on your balance sheet to pay that dividend forever. And it's fairly unvolatile. The question is, I guess, who would actually want to hold the common stock because you need someone to expect that gold would outperform, the credit that you're issuing. So maybe that's kind of where it would break down is no one would ever really want to hold the common stock. But gold's such an interesting asset because it's like, over the last couple of years, it's gone up more than 10% per year. But, on average over the last, I don't know, 55 years or so, it's gone up like 7% per year. So like the MNAV on a gold treasury company, I feel like could be incredibly volatile where it's like over the last couple of years, maybe that everyone would want to be investing in a gold treasury company, but in normal gold market conditions, maybe no one would want to be holding the common equity. I don't know. Those were my thoughts the other
Yeah,
day.
I have a couple more thoughts. And it's
Yeah.
interesting as you were speaking through it, I guess, if you look back through history, all the banks that ever accumulated gold and lent out gold were in effect gold treasury companies. And they could not just sit on the gold and custody the gold, I guess because the creditors had their obligations denominated in gold and they were getting a yield on top of gold and they could redeem for gold. So the banks had to go out and lend out the gold and generate some sort of yield on that. But the entire world did run on gold backed credit. The only difference being that the credit was denominated in gold and could be redeemed in gold, which I think is where maybe the parallels break down. Where in this new Bitcoin treasury model or gold treasury model, as you are conceptualizing, the credit is not denominated in gold or Bitcoin anymore. It's just denominated in fiat because it exists and it's being used so commonly. So maybe there's a case to be made that something like that could happen. What would be more interesting though is to do it with the S&P 500 basket of stocks, because uh, that would perhaps be exactly what the equity cost of capital is. You
Mm.
could lever up by issuing credit against it, and the equity tranche, then the common equity would outperform the S&P 500 because of the nature of leverage. So there's like an S&P 500 treasury model. And the reason it doesn't work is because a listed company cannot put those many of their assets into the S&P 500 or securities, and
Mm.
it starts breaching the 40 Act, and you're no longer an operating company, you become an investment company, and then you don't have the same flexibility in your capital structure and so on. So yeah, I think definitely the one thing we can agree on is it works best with Bitcoin.
Yeah. Yeah, exactly. Um, what do you think about the future of Bitcoin volatility? You know, you can very clearly like look at historical Bitcoin volatility and see that it's trending down, even with the last 2 days. It spiked up obviously in short term, but in the grand scheme of things, it's still pretty low compared to what it has been over many years past. Do you see it continuing to trend down?
I think so. I think I agree with the thesis that it has already been trending down and it will continue to trend down. And also that the performance on a year to year or cycle to cycle level will also keep coming down with time. As it just becomes a larger and larger capital base, then you will perhaps not have the same level of annual return or annual volatility. And maybe 4 years ago it was a 70 wall, 70 ARR asset. So today it's more like a 40 wall, 40 ARR asset. And it keeps compressing the volatility as the capital base grows bigger. And it does two things. One, it starts attracting more kinds of capital didn't that can't take in or can't handle the volatility. And second, you also need generally a larger and larger capital base to draw in other pools of capital, because if Bitcoin is just $100 billion, then no large pension fund is going to think of allocating $5 billion or $10 billion to Bitcoin, because that's too high. It'll be so difficult to liquidate that position without moving the market. And now that's $2 trillion, it would be far easier for someone to allocate 5, 10, $15 billion. So you need both the size to keep going up and the volatility to keep coming down to be able to draw in more capital. And as a result of drawing in more capital, you end up reinforcing it. You end up increasing the size and bringing down the volatility, which then ends up drawing more and more capital. So I think it's just going to play out that way for the next few years. It's hard to imagine that the volatility suddenly spikes up and stays at very elevated levels for a long time. I think it's just going to keep trending down.
Yeah, I tend to agree. I was playing around with Strategy's website and like my own models as well, and specifically Strategy's website. You go on the credit tab, you drive down volatility to zero to exaggerate. It makes the risk on digital credit, very little. Even if you assume Bitcoin is going to go up 0% per year, like its volatility is a pretty key component of the uh, statistical risk of digital credit. Do you think that that's going to like declining volatility over time is going to be a huge boon to digital credit?
Yeah, I think so for sure. And I think you look at the world today, the exposure in fixed income is a lot higher than the exposure in equity. So there is more capital that wants shorter term savings like monthly income exposure as opposed to risky equity like investment bets. And you need securities like digital credit to bring in that capital into Bitcoin. And as the volatility comes down, they become more and more attractive because they become more and more convincing as a way to store value that's more shorter term in nature as opposed to the longer term equity investment bet. And yeah, I expect that trend to continue, that the vol keeps declining. The companies keep paying dividends on Stretch, SETA, and other digital credit instruments. And you just see more and more capital enter the ecosystem. Yeah, I guess that's the way I see it.
Yeah. One thing that I really liked from the Strategy earnings call yesterday was the quantum resistance initiative and trying to help the cryptography community, the computing community, the Bitcoin community kind of like research and I guess evaluate potential solutions. Like, I'm wondering, was that like a hot topic? Are you aware of investors that were highly concerned about quantum? Because like, on Twitter, from what I've seen, like, it's kind of been a hot topic recently. But I'm wondering like if any, major investors, whether it's Bitcoin or Strategy or whoever, have expressed major concerns.
Yeah, I would say we haven't heard any major concerns from large institutional investors in the stock. What we have heard maybe is obviously the online chatter on Twitter, and let's say through some research analysts that might be covering MSTR, the stock, or are generally covering the space. I think they are hearing on the margin that there might be some new investors that are getting skeptical because they don't understand the risk. And while a lot of Bitcoiners, myself included, think that quantum as a risk to Bitcoin is maybe 20, 30 years away to maybe never ever being a risk, it still becomes maybe a bit meaningful to address the concerns. and to address that fear, because it's pushing away investors at the margin. And you need to convince them about what the risk really is, and that there could be a potential path to mitigate that risk in the future, because Bitcoin is just a software that can upgrade. And the intention with this was something similar with what happened before my time at Strategy, where Strategy, or at the time MicroStrategy, had formed like this, or had taken a leadership role, or just a role in this battling the energy FUD, and forming like the
Mm,
mining council of sorts, bringing in a lot of large Bitcoin mining players to address the criticism that Bitcoin mining was getting, because it is boiling up the oceans, and spending a lot of money on energy, and creating these ESG sort of threats. And it was just kind of facilitating the discourse and creating some structure around it, and just supporting the ecosystem and bringing in different parts of the community in to have a thoughtful, detailed discussion and present sort of views back to the market, back to investors. And it's something similar with the sort of quantum fear and threat today, about just playing a role in facilitating the discussion, supporting the ecosystem, bringing together different communities, and just having thoughtful research and then thoughtful articulation of that research happen, which is important because there's already a lot of research happening. It's not like
yeah.
people are blissfully unaware of the quantum topic and no one is doing anything. There are already BIP proposals, and there are already a lot of different Bitcoin sort of think tanks or dev groups that are proposing different ideas on how to deal with it over the long term. So it's already happening. And I think it's just maybe responsible for Strategy to also step in and also facilitate that discussion, and create meaningful discourse around it.
Yeah, I think it's a great initiative, and I was, thinking about it like eh, large Bitcoin holders, have been funding like Bitcoin related research and all sorts of things like this for a while. But it's like you kind of need to be a significant holder to like really want to deploy, sponsor a developer to, for a couple years or something to do some deep research. And it's almost like these public Bitcoin treasury companies that have thousands of Bitcoin and are increasing that Bitcoin per share on behalf of shareholders, like there is like, I guess, potentially, especially with Strategy, like a little wiggle room to like say, like, hey, here's a little bit of, wealth that we have. Let's make sure that our stockpile or treasury is going to, not just break overnight. Not that it necessarily would, but it's like it makes sense that this is exactly, the type of institutions and people that would help, prevent quantum from being a big issue for Bitcoin.
Yep, I agree. And I think that the careful balance over there is, even if you leave aside quantum and you just think about funding developers, you don't want to ever create a misaligned incentive where
Yeah,
you end up funding developers, and the only way for them to continue to get more funding is by proposing more and more changes to the protocol. Uh, and that can be a very risky sort of slippery slope that you don't want to go down. That, as Michael Saylor again describes it, over enthusiastic developers that want to do good and are just proposing more and more changes and introducing more and more attack vectors to the code. You want to keep it simple, you want to keep it clean, you don't want to add unnecessary functionality that proposes risk or introduces risk, but you do want thoughtful research, thoughtful proposals that, once there is universal consensus that you do implement a proposal, it meaningfully reduces the risk and everyone agrees to it. And that is then implemented. Like, that is what's important. And then you need to have the right sort of incentives in place, and avoid that over enthusiasm of proposing too many changes that are unnecessary, that don't solve for Bitcoin continuing to be sound money and change that philosophical direction. Like, that's something you want to avoid.
yeah. No, I agree with that as well. This is one of the last questions. What do you think is the biggest misunderstanding of Bitcoin treasury companies or Strategy, if you want to answer that in particular?
Yeah, that's a tough question because there are so many sort of criticisms and so many points that are misunderstood. It's hard to find one. I think the most common one definitely is the idea of Strategy being a forced seller. And I think that is inevitable, that the fear will come up each time Bitcoin's price crashes, because there will always be new investors on the margin that are discovering Bitcoin, or discovering Bitcoin
Mhm.
treasury companies that then easily get swayed by the new critics that are emerging as well, that are again paying attention for the first time, are seeing some leverage on the balance sheet and are arguing that, oh, this is not sustainable. The price crash will wipe them out and they'll have to sell their Bitcoin. And so that's a big misunderstanding, that whatever little debt we have, our strategy on a balance sheet today is all convertible debt with staggered maturities starting 2028 all the way to 2032. And that's just 10% in terms of net leverage relative to a balance sheet. So Bitcoin like crashes, or maybe now 15%, depending on where the Bitcoin price is. Bitcoin crashes 85, 90%, stays there for multiple years, is when, any problem might come out of this situation. But otherwise, it's not really a risk. The leverage is super low, and the intention is to phase out that leverage. And then you can withstand any kind of volatility and any kind of drawdown in the interim. The common equity would end up being very, very volatile if there is a lot of volatility, but the company never faces a threat of being insolvent or being dragged into bankruptcy because they aren't fulfilling the debt obligations. So that's one very common misunderstanding. And I think the second also is this idea of maybe strategy being, or other Bitcoin treasury companies as well, being similar to Ponzi's, because they keep raising more and more capital and they pay returns on one form of capital with another form of capital. And the distinction over there is that Bitcoin treasury companies are actually investing in an asset that is appreciating on the back end. And you could, in theory, borrow from a set of investors at, let's say, stretch investors, 10%, invest in Bitcoin going up 30%. And in order to fulfill the 10% dividends each year, you just sell the Bitcoin and you sell small slices of the Bitcoin and you make whole the dividend payments each year. And the strategy still works very well, because as long as Bitcoin appreciates at 30%, the remaining Bitcoin that you have left over each year after fulfilling the dividend payments is going to, in time, appreciate a lot more and give you a lot more asset value relative to the liability you created when you sold Stretch to buy Bitcoin. And hence the equity still ends up outperforming Bitcoin. So you can, in theory, do that. But the common investors don't want you to sell the Bitcoin to make whole the dividend payments. They rather want you to issue more capital and hold on to the remaining Bitcoin as well and capture the entire 30% appreciation in all the Bitcoin that you sort of bought. And that's why the companies opt to fulfill the dividend payments through the issuance of new common equity. And if you do it at elevated MNAVs, then it's even better, because then it's even cheaper to fund it and you would hence do it more and more. But the point is that you could just do it without having to fund it through new common equity sales. You could do it with just Bitcoin sales, but it's just a weaker model that investors don't want. And that's the reason you rely on continuous capital raising for both buying Bitcoin and funding the dividends. And you just keep sitting on the entire Bitcoin stack, keep letting it grow at 30, 40, 50%. And you make a lot of returns for both your credit investors and your equity investors. And the model works perfectly fine. And it's all very symbiotic. Everything like reinforces the other component in the system. And yeah, and it's just a beautiful design. It's very elegant.
Yeah, I saw a post that said that strategy is going to get liquidated at $60,000 or something like that, and it had like 300,000 views, and I'm like, it's like, how are people sharing this and believing this? It reminded me like of just Bitcoin in general, where it's like, oh, this doesn't work for XYZ reason. And it's like, I mean, like if you look into like how this actually does work, it's pretty obvious that you're wrong on, X, Y, and Z. And it's just the same thing over and over again, which to me like makes me so optimistic about, the future of Bitcoin, where the critics, they may be perceived to be, highly intelligent. They may be highly intelligent in certain fields, but a lot of their critiques on something like Bitcoin are just, flat out like not correct.
Yeah. When everyone agrees and is on board with Bitcoin being a great investment, then it's no longer a great investment. So I think all of us are grateful right now that there are a lot of critics of Bitcoin and of Bitcoin treasury companies, because that is what provides like the generational buying opportunity, and the opportunity to retire your bloodline. So I think it's a matter of adoption, which is a matter of like just mind share of Bitcoin and good understanding of Bitcoin spreading like a mind virus. And it's just going to take a lot of time. And we'll eventually get there. It's a question of when we get there. But up until then, yeah, all of these misunderstandings will continue of strategy getting liquidated at 60K, 50K, 40K, 30K. And 5 years from now, it'll be strategies getting liquidated at 400K, 300K, 200K,
Yeah,
100K. I don't think it's going to stop. It's always going to be there, but we're going to battle through it all.
I like it. Yep, I agree. Well, CJ, thanks again for the conversation. This has been awesome. Any final closing thoughts?
No, nothing specific. Thank you so much for having me on, Joe. I really like chatting with you. I hope to see you soon at Strategy World and Bitcoin for Corporations happening in Vegas, February 23rd, 24th, 25th. I hope a lot of the listeners will be there as well. It's a great event, great chance to meet a lot of Bitcoiners, especially the ones that are more involved in the traditional finance space and the Bitcoin treasury space, and people across companies, banks, research analysts, investors, all kinds of people. Um, so I think I'm excited for that. And I'm excited for the next chat that we have sometime soon. Let's hopefully record another one of these podcasts, this year.
Absolutely. We'll definitely do it. And I will be at Strategy World. So I'll see you and many other people there. So that'll be fun. But
Yep. Yep. Looking forward to it.
yeah, absolutely. But CJ, thanks again. This was a great conversation.
Thank you so much, Joe.